In 2025, you need to own at least 0.1 Bitcoin. Most people think they need a full Bitcoin to make it in crypto. They're wrong. With Bitcoin now trading above $110,000 and Michael Saylor predicting it could reach $21 million per coin, owning just 0.1 Bitcoin might be one of the most important financial decisions you make this decade. Here's what almost nobody realizes. There will only ever be 210 million pieces of 0.1 Bitcoin in existence. That's it. With over 8 billion people alive today, even if just 2.5% of the population tried to own 0.1 Bitcoin, there wouldn't be enough to go around. But this isn't just about scarcity. Michael Saylor, the man who turned MicroStrategy into a $95 billion Bitcoin powerhouse, has been sounding the alarm about a supply shock that's already underway. His company alone has accumulated over 638,000 Bitcoin. That's over 3% of all Bitcoin that will ever exist, and he's not slowing down. In this video, I'm going to break down exactly why Saylor believes Bitcoin is heading to $21 million per coin, how his supply shock theory is playing out in real time, and why accumulating just 0.1 Bitcoin could be the difference between financial freedom and watching from the sidelines. We'll dive into the policy shifts that have Wall Street scrambling to get Bitcoin exposure, the institutional buying frenzy that's absorbing more Bitcoin than miners can produce, and the mathematical certainty behind Saylor's most ambitious prediction yet. But before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from these breakdowns, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now let's hear from Michael Saylor himself about the policy environment that's driving this unprecedented Bitcoin adoption.
The first thing that I'll note is we have a very supportive White House, and that started with the establishment of the Bitcoin Strategic Reserve, but it continues across the board. Next. As you can see, we have 12 cabinet members in this administration that are all pro-Bitcoin. A year ago, we had one cabinet member who was neutral and 11 that were indifferent or uninterested and certainly not supportive. So this is a major change in the political landscape. Yesterday, the White House released a crypto policy report. It's about 150 pages long. I did a scan. I'm sure some of you have done a scan. The takeaway is that this administration is going to be very enthusiastic in its support of the entire crypto industry and the Bitcoin ecosystem. And in particular, some of the things they're doing include work in the area of taxation to cure unfair tax treatments of digital assets. And that includes, relief for de minimis digital asset transfers like de minimis Bitcoin payments. And it also in guidance, digital assets should not be included when calculating CAMT unrealized capital gains taxes or when calculating CAMT minimum taxes. And so we have the support of the administration on this, and that was made very precise in writing just yesterday, and this is an excerpt of it. I think this is just very positive for the entire crypto industry and very positive for Bitcoin. And of course, it's very positive for the hundreds of companies that are starting to put crypto assets on their balance sheet. Wall Street's embraced Bitcoin. We've now got 80 ETFs launched, $170 billion of value flowing into these ETFs. These continue to pick up steam, and they're growing more powerful day by day.
What Saylor just outlined represents the most dramatic policy shift in Bitcoin's history. We've gone from a regulatory environment where Bitcoin was viewed with suspicion to one where it's actively embraced at the highest levels of government. This isn't just political theater. The White House's 150-page crypto policy report specifically addresses tax treatments that have been roadblocks for institutional adoption. When digital assets are excluded from unrealized capital gains calculations and get relief for small transactions, it removes massive compliance burdens that have kept companies on the sidelines. Wall Street's response has been swift and decisive. Those 80 ETFs that Saylor mentioned have pulled in $170 billion in value. But what's remarkable is the speed of adoption. BlackRock's Bitcoin ETF became the fastest ETF in history to reach $10 billion in assets, hitting that milestone in just 7 weeks. This institutional infrastructure creates what Saylor calls a supply shock. But we're just getting started. Let's look at how public companies are racing to join what's being called the Bitcoin 100.
Public companies are capitalizing on Bitcoin. This is an extraordinary move. And of course, we're seeing these every day. There's a new announcement, whether it's coming from a pure Bitcoin company or whether it's coming from a hybrid or just a random new entrant. But we've now got 950,000 Bitcoin that have been acquired by 160 different listed companies. And we look at the trend. We were the first in 2020. There were 2 at the end of the year. Then there were 33. 39, 43. There were 64 last year. And of course, as you look at this trend right now, 160 when we're not even to the end of 2025 is extraordinary. So we're in hyper growth or hyper adoption phase for Bitcoin as a treasury reserve asset. Companies are racing to get into the Bitcoin 100. You can see there's even competition to track the Bitcoin 100 right now. And generally, any given week, there are 20 or more companies that are acquiring more Bitcoin. Just a few minutes ago, Coinbase announced that they acquired more Bitcoin this quarter, thousands of Bitcoin. So I see very positive trends here. And each of these companies could, in theory, acquire just as much Bitcoin or attempt to acquire just as much Bitcoin in a dollar value as we have acquired. Obviously, they won't get 3% of the Bitcoin supply, but you can imagine what happens when 100 companies are all competing to acquire as much Bitcoin as possible.
The numbers Saylor just shared are staggering, but they tell only part of the story. Those 160 companies holding 950,000 Bitcoin represent a fundamental shift in how businesses view their balance sheets. What's driving this corporate FOMO isn't speculation, it's mathematics. Every day, only 450 new Bitcoin are created through mining, worth about $50 million at current prices. But the demand from these treasury companies alone is absorbing far more than that daily supply. MicroStrategy leads the pack, but companies like Marathon Digital, Bitmine, and dozens of others are following the same playbook. They're issuing stock, raising debt, and converting cash into Bitcoin at a pace that's never been seen before. In July and August 2025 alone, corporate treasuries added 140,000 Bitcoin to their holdings. The competitive dynamic is accelerating. As Saylor noted, when you have hundreds of companies competing to acquire just as much Bitcoin as possible, basic supply and demand economics take over. There simply isn't enough Bitcoin to satisfy this level of institutional demand. But it's not just corporate treasuries driving this supply crunch. Wall Street analysts are now required to form opinions about Bitcoin, and their forecasts are getting increasingly bullish.
The analysts are all starting to cover and track Bitcoin, and they have outlooks for Bitcoin. So if you're going to cover the 160 Bitcoin companies that have Bitcoin on their balance sheet, you're going to have to form an opinion about Bitcoin. And so you can see that the average end of the year price forecast, equity analysts covering MSTR, is 168,000. And so keep that in mind, 168,000 by the end of the year. That's the consensus of the analyst community that tracks our stock right now. Technology investors are looking for the next great thing, and the consensus trade is AI. Everybody knows AI is the next thing, but now they're starting to realize that Bitcoin is also the next thing, and it's being lumped as a technology transformation and a digital disruption. This is really positive because this is going to draw lots of Magnificent Seven investors into our space.
That $168,000 consensus price target from equity analysts tracking MicroStrategy isn't an outlier. It's becoming the mainstream view on Wall Street. When major investment banks have to cover Bitcoin companies, they can't ignore the underlying asset. This creates institutional validation that goes far beyond the crypto echo chamber. The convergence with AI investing that Saylor mentioned is particularly significant. The same Magnificent Seven investors who have driven AI stocks to record highs are now viewing Bitcoin as another technology disruption play. This brings a new class of institutional capital that wasn't previously interested in crypto. Technology investors understand network effects and adoption curves. When they look at Bitcoin's growth trajectory, from zero to over $2 trillion in market cap in just 16 years, they see patterns similar to the internet and smartphone adoption. This isn't speculation, it's pattern recognition applied to digital assets. But the real acceleration is coming from regulatory changes that are removing the final barriers to institutional adoption.
Financial regulators are embracing Bitcoin. You see a new positive Bitcoin announcement just about every other day now from all parts of the government. Just a few days ago, the SEC released a memo allowing in-kind creation and redemption of Bitcoin ETFs. This is a huge deal. This is going to accelerate the development of the industry. They also loosened restrictions on options trading, Bitcoin ETFs. Paul Atkins just gave a speech and made a number of comments about the digital assets industry. It's clear that he's very supportive of innovation, very supportive of the crypto economy, very supportive of your right to self-custody, and this is a welcome development from the SEC. Another welcome development is the guidance that came from William Pulte to Fannie Mae and Freddie Mac, where he said they should prepare their businesses to count cryptocurrency as an asset in a mortgage. This is going to accelerate the institutional adoption of Bitcoin as collateral in the banking industry. There could be no more legitimate driver of the collateralization of credit with Bitcoin than the U.S. Federal Housing Authority. Capitol Hill is embracing Bitcoin. There are 3 bills. One of them, the Genius Act, has already been passed. Clarity is coming in September, and the Bitcoin Act allows for the government to acquire 1 million Bitcoin. These are picking up momentum. This is a positive development. U.S. states are also embracing Bitcoin. We've now got 3 strategic Bitcoin reserves, including one in Texas just recently that was funded with $10 million. So this is a trend that's growing. International governments are enthusiastic about Bitcoin, and we're seeing this everywhere in the world with politicians in Ireland and the UK and Pakistan and UAE in Ukraine, etc. All of them making pro-Bitcoin moves. The crypto industry has coalesced around Bitcoin. There used to be some conflict 2-3 years ago. I think the previous administration played the crypto industry against the Bitcoin industry, and now they've come together, and it's pretty clear that Bitcoin is viewed as the foundation of the entire crypto economy. And we see that as really, really constructive for the growth of the entire industry.
The regulatory developments Saylor outlined represent a complete reversal from just 2 years ago. The SEC allowing in-kind creation and redemption for Bitcoin ETFs is a technical change that will dramatically increase liquidity and reduce costs for institutional investors. The guidance allowing Fannie Mae and Freddie Mac to count cryptocurrency as collateral for mortgages is perhaps even more significant. This means Bitcoin holders can unlock the value of their holdings for major purchases without selling their Bitcoin. It's similar to how wealthy individuals use stock portfolios as collateral for loans. These changes are creating what economists call the wealth effect. As Bitcoin becomes more useful as collateral, its utility value increases, which supports higher prices, which makes it even more attractive as collateral. It's a reinforcing cycle that's just beginning. The international adoption Saylor mentioned amplifies this trend. When governments worldwide are making pro-Bitcoin moves, it creates a global race where no country wants to be left behind. Now, let's talk about why this all matters for someone looking to accumulate just 0.1 Bitcoin. The supply dynamics are unprecedented in financial markets. Over 94.85% of all Bitcoin that will ever exist has already been mined. Of the remaining 1.1 million Bitcoin left to be created, institutional demand is absorbing new supply faster than it can be produced. Exchange balances have fallen to their lowest levels since 2018, with less than 11% of Bitcoin supply available on trading platforms. Meanwhile, an estimated 30% of all Bitcoin is considered permanently lost, locked in wallets where the keys have been forgotten or destroyed. This creates what Saylor calls the supply shock, a point where available Bitcoin becomes too scarce to meet demand, triggering sharp price moves upward. The mathematics are simple. When institutional buyers need more Bitcoin than exists in liquid markets, prices must rise to incentivize holders to sell. Here's where the 0.1 Bitcoin target becomes critical. With only 21 million total Bitcoin, there can only ever be 210 million pieces of 0.1 Bitcoin. Put that in global context. If just 2.5% of the world's population tried to own 0.1 Bitcoin, there wouldn't be enough to go around. But most people don't even think about Bitcoin, which creates an opportunity for those who understand the mathematics. At current prices around $110,000, 0.1 Bitcoin costs about $11,000. For many people, that's achievable through dollar cost averaging over 6 to 12 months. But if Saylor's $21 million prediction proves correct, that 0.1 Bitcoin would be worth $2.1 million. The beauty of the 0.1 Bitcoin goal is that it's both accessible and meaningful. Unlike trying to accumulate a full Bitcoin, which costs over $100,000, the 0.1 target allows regular investors to gain significant exposure to Bitcoin's upside potential. The math shows that owning 0.1 Bitcoin puts you ahead of more than 98% of the global population in terms of Bitcoin holdings. As institutional adoption accelerates and supply tightens further, even this fractional ownership could prove to be life-changing. Saylor's $21 million Bitcoin prediction isn't based on hope or hype. It's rooted in his analysis of global monetary flows and asset reallocation. His updated forecast calls for Bitcoin to reach $21 million by 2046, which implies steady growth of about 20 to 25% annually from current levels. For Bitcoin, which has historically grown at much higher rates during adoption phases, this is actually a conservative projection. The mechanism driving this growth is institutional reallocation. As Saylor has explained, if Bitcoin captures even a small percentage of the value stored in global real estate, bonds, gold, and stocks, the price implications are enormous. Consider that global real estate is worth about $380 trillion, bonds about $128 trillion, and gold about $23 trillion. If Bitcoin absorbed just 5% of these traditional store of value assets, it would represent over $25 trillion in value, roughly $1.2 million per Bitcoin at today's supply levels. But Saylor's thesis goes further. He believes Bitcoin could eventually absorb 50% or more of these asset classes as digital money proves superior to physical alternatives. Under that scenario, $21 million per Bitcoin becomes not just possible, but inevitable. For retail investors, the key is starting accumulation now, before the supply shock makes Bitcoin dramatically more expensive. The most effective approach is dollar cost averaging, investing a fixed dollar amount regularly regardless of price. This strategy reduces the impact of volatility while building a consistent position over time. Many successful Bitcoin investors set a target of 0.1 Bitcoin as their first major milestone, then continue accumulating toward larger goals like 0.21 Bitcoin, 1 millionth of the total supply, or eventually one full Bitcoin. The important thing is to start. As institutional adoption accelerates and supply tightens, the opportunity cost of waiting increases with each cycle. What costs $11,000 today, 0.1 Bitcoin, could cost $50,000 or more in just a few years if Saylor's supply shock thesis plays out. We're witnessing the early stages of what could be the largest wealth transfer in human history, as traditional institutions move from skepticism to aggressive accumulation. Retail investors who position themselves early stand to benefit enormously. The approval of Bitcoin ETFs, the regulatory clarity from Washington, and the corporate treasury revolution that Saylor pioneered have created conditions unlike anything seen in Bitcoin's previous cycles. This isn't speculation anymore. It's institutional reallocation on a global scale. When pension funds, endowments, and sovereign wealth funds begin allocating to Bitcoin, the supply available to retail investors will shrink rapidly. The companies and individuals who accumulate Bitcoin today, even in fractional amounts like 0.1 Bitcoin, are positioning themselves for what Saylor calls the most asymmetric trade in financial history. As regulatory frameworks solidify and institutional products proliferate, the question isn't whether more money will flow into Bitcoin. It's how quickly institutions will move before the opportunity cost becomes unbearable. For retail investors, 0.1 Bitcoin isn't just a number. It's a position in an economic protocol that's transforming how the world stores and transfers value. In Saylor's words, Bitcoin is becoming the dominant monetary technology of the 21st century. And if you want to stay ahead of these massive institutional moves and know exactly when the supply shock indicators are flashing, I break down the key signals every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. You'll get clear insights on accumulation strategies, institutional flow data, and the on-chain metrics that matter most for timing your Bitcoin investments. Just click the first link in the description, enter your email, and you're in. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next one.